I'm Motley Fool Canada senior analyst Nick Seipel, and this is the 5 Minute Major, here to make you a smarter investor in about 5 minutes. Today, we're discussing earnings reports from the big six Canadian banks and what to expect from this group going forward. My guest today is Hidden Gems Canada lead advisor, Jim Gillies. Jim, thanks for joining me.
Thanks, Nick. I've got my evil Santa Claus beard and my Quebec Nordiques hat, so I am ready to talk Canadian banks.
Let's do it. The banks have been monster performers in 2025. On a total return basis, the average return of the big six Canadian banks is over 40%. That is incredible performance. But coming into their earnings reports last week, some analysts were worried these stocks could have been priced for perfection. Did they deliver with those earnings releases?
They more than delivered. The results heading in, I was certainly not one who was skeptical of the banks going in here. I've been a big proponent of the Canadian banks for a while now, but expectations going in were that earnings the Canadian banks have an October fiscal year, so this was fiscal Q4, by the way. Expectations were for earnings to be up between 12 and 24%, largely on the strength of fee income at the various divisions, as well provisions for credit losses, which were fairly high in the first half of the fiscal year, were expected to, you know, to be reined back a little bit. It's been generally a pretty good year for the Canadian banks. So expectations, like I say, 12 to 24%. They came in at an average of 29%. So they looked at the top end of the range and said, yeah, see you, and we'll add 5 points. The numbers ranged from the very, very strong at Bank of Montreal, which was where the results were up 73% year over year, down to National Bank of Canada, which only saw Q4 earnings up by 9%. The other thing is too is that the Canadian banks have long been, as we were talking before, we like to call these widows and orphan stocks. They're both dividend stories as well as dividend growth stories. And five of the six big banks all bumped their dividends. The stellar one there being CIBC, which raised it at 10.3%. And the one sitting on their hands is apparently Bank of Nova Scotia for some reason. Everything looked, frankly, all looked really good. And, that may sow the seeds of a problem to come. But for now, it's been a fantastic run.
Yeah, so really the story of 2025 and the story of these earnings reports is, solid performance above the expectations of what the market had coming in to the year. Obviously, on the back of average performance over 40%, that's difficult to match that up as we move in to 2026. So what should we expect from the big six Canadian banks in 2026? Is another year of outperformance on the horizon for the group, or do investors need to be more selective next year?
Well, I mean, obviously, we can't say outperformance yet because we don't know what the market's going to do. And the Canadian market's been very strong this year. Thank you, gold. But I am personally expecting, and I own four of the six of these standalone, and I also own a not small amount of a particular ETF. We've recommended in a bunch of the Canadian stock picking services that is an equal weight with a slight amount of leverage type ETF that owns all the big six. I am not expect. I expect they will turn in a lower result next year than they did this year. Now, as you said, it's almost up almost 40% with total return. So bold call there, Jim, being less than 40, right? But I think you have to remember, like historically, the big banks give you 7-8% a year capital appreciation plus 3-4% dividend yield on top. Reinvest that, never touch them. That's a pretty good deal. But when we were in the middle of COVID, and really even just after COVID, the banks were trading in the 10 times earnings range, and about 1.3 times book value was recently, on average, as recently as 2023. Their long run average is in the 12 to 13 times earnings, and about 1.8, 1.9 book value. Well, as of today, like as of this moment, the average Canadian bank is trading for 14.8 times earnings. And I tend to be a mean reversion kind of guy when you see these things when the banks go. So it wouldn't shock me if we get a little bit of muted gains going forward as these things revert back to 12 to 13 times average. The dividend yield as well. We've now got a couple, National and Royal, that are below the magic 3% level. Which there were times you could have bought this like I said as recently as 2023, and you were getting more than 5%. It was well after COVID and well after the Canadian government allowed the banks to up their payments. But I'm expecting a muted gain below 40, probably below 20, below 10 wouldn't shock me. And I'm going to do precisely nothing. I'm going to keep reinvesting my dividends. These are the bedrock of any good Canadian investor's portfolio.
Yeah, it's a reminder that while valuation might bounce around from year to year based on market expectations, these are companies that, you describe that growth algorithm year over year are growing their earnings, growing along with the overall economy. And I don't think you would expect that to change given the structure of the Canadian banking system.
Yeah.
That's all the time we've got for this edition of the 5 Minute Major. Reminder, if you want more stock ideas from us, click the info icon in the upper right-hand corner. Thanks for joining us. Hope to see you next time.